All right, hopefully everybody can see the title. We got a lot to talk about here. Hopefully this is going to be interesting. Let's take a chat window. And hopefully we don't have any other issues as we get going here. Okay, so welcome everybody. This is part 2 of supply and demand, making it objective. Hopefully everybody has had a chance to see part 1, because we will be referring back to some of the things that were covered in part 1. In particular, we're going to be referring back to swing highs and swing lows and the way those are defined and found. We're also going to be referring back to base highs and base lows, because we'll be using those later when we start talking about trend changes and changes in the direction of price moves. So let's get things started here. There we go. So we're going to start talking about trend. I'm going to start out with some definitions of it, and we're going to build on those. We're going to start looking at the parts of a trend, the impulse moves, the corrective moves. Then we're going to get into the relationship between those and trends on lower intervals. And we're going to be able to see things like why you can have a trend on the lower interval that's moving in the opposite direction from a trend on the higher interval. So that's going to be an interesting discussion. Then we're going to get into curve and our particular definition of curve and how to find it and use it. We'll get into a method for finding the curve. That's pretty simple to do, particularly if you're doing it by hand. And then we're going to go actually look at some backtest results, because one of the things that people want to know is the zones or bands, whichever term you prefer, that are found using this objective methodology. How well do they actually work? And so we'll actually go and we'll look at some examples of that. And then we'll even look at some examples of pulling things together and the overall supply and demand trading methodology. So there's a lot of stuff we're going to try to cram in here into the next 2 hours. If you have any questions, please feel free to either put them in the chat or use your microphone. So we'll try to make this an interactive session. And this is being recorded. Knock on wood here, hopefully, if everything goes right. So when it's done, we'll be able to go and post this on YouTube. So both parts of this will be available on YouTube. So that's our agenda. So let's start out with the question of what exactly is trend? Trend is a concept that's not unique to trading. You see trends in all sorts of things around us. Obvious things are trends in temperature, for instance. During the spring, temperature tends to trend upward, and during the fall, it tends to trend downward. We see trends in animal populations and water levels. You see trends in all sorts of things. So the concept of trend is not unique to trading. It's just something that we are using in trading as it's used in a lot of other places. So basically, what then is trend? Well, from our perspective as traders, trend is basically the tendency of price to move in a particular direction. And because we're traders, there's only 3 directions. Price can move up, down, or it can go sideways. Now, trend is composed of impulse moves and corrective moves. You've probably all heard that before. What exactly are those? Well, a simple definition is that impulse moves are moves in the direction of the trend, while corrective moves are moves against the direction of the trend. And that's a simple, intuitive definition. However, it's lacking in certain respects. One of the problems with this definition is that it doesn't tell us how many candles on our charts we need to form an impulse move or a corrective move, or a trend for that matter. So can an impulse move be a single candle? In which case, in an uptrend, every green candle is an impulse move, and every red candle is a corrective move. Or do we need more than one candle to confirm a move? What about changes, where we change from an impulse move to a corrective move? How is that identified? Particularly when you start having your impulse moves and corrective moves being composed of multiple candles. So these definitions, while intuitively they make sense, there's a lot of details that are missing. Now, according to the internet, the concept of the impulse and corrective moves comes from Elliott wave theory. However, after trying to make sense of some of their stuff with respect to impulse and corrective moves, I didn't see anything objective there to tell me when an impulse move is starting or ending, or a corrective move is starting or ending either. I found that rather confusing, and I didn't find any other objective definitions for these on the web. So basically, within the project that this all comes from, we've created our own definitions telling us where these impulse moves start and end and the corrective moves start and end. And we have made those objective. So basically, what we're saying is that at each point where price movement goes from being an impulse move to a corrective move, we expect to find a swing high or a swing low. And if we look at our drawings down here with our sample trends, you can see here how we have our corrective moves and our impulse moves in the downtrend. And again, in the uptrend. And you can see each of these turning points where we go from an impulse move to a corrective move, whether it's an uptrend or a downtrend. It's a sharp change in direction for price. And because of the definition of swing highs and swing lows, they fit very nicely with these changes in direction. So we're going to look at using swing highs and swing lows to objectively define these turning points. And essentially then that will become a definition for where an impulse move or a corrective move would start and end. And we're going to use the rule of two. The rule of two is something that is quite popular within trading. It means basically that we want to see two of something occurring before we'll consider it a valid item, whatever it happens to be. So what we're going to do is we're going to look for, in the case of a change from an upward move to a downward move, we're going to look for a swing high which has two or more lower swing highs on either side of it. This marks it as a significant swing high because we've had lower swing highs on either side of it. And that fits very nicely with the way we tend to draw trends and the changes from impulse moves to corrective moves and vice versa. And then for the other case, where price is moving down and it transitions to moving up, again, we're going to look for the equivalent, which is going to be a swing low with two or more higher swing lows on either side of it. So that gives us a very nice objective way to find the start and end for these impulse moves. And this will help us then in finding the impulse and corrective moves that comprise the current trend. Now, this is going to give us a higher level trend on whatever time frame we're looking at. Trend is one of those things that is very fractal. And mathematically, when something is fractal, you can divide it infinitely, and you always end up with something that has the same properties as what you started with. And trend is kind of like that. You can look at other turning points. For instance, if you go and you look at just swing highs and lows by themselves without looking for two or more on either side of it, and you're going to get something that looks just like a trend, but it's going to be a very low-level trend that flits back and forth very quickly. By defining it the way we did using the rule of two, we get rid of a lot of the excess noise, which is in the price signal, and a lot of the flitting back and forth that you see on very low-level trends or on very low-level intervals. So that was another reason for using the rule of two here. It gives us something that's a lot more stable. Now, what we've done so far is we have basically defined the impulse and corrective moves, which are part of the trend. So now it's time to define the trend itself. And when we define the trend, we're also going to end up using the rule of two. So in the case of a downtrend, we're going to have at least two consecutive lower highs and lower lows. For an uptrend, we're going to have two consecutive higher highs and higher lows. So as we see down here, we have our impulse down. We have our correction. This gives us a lower high here. We have another impulse down. This gives us a lower low. We have our impulse, our correction up here. This gives us a lower high. Our next impulse down gives us a lower low. So we have the two lower lows and we have the two lower highs. This is our downtrend. And for an uptrend, it's the same pattern. We just flip it upside down. And so here we have an impulse move. It goes and gives us a higher high. Yet the correction gives us a higher low, another impulse, higher high, correction, we get a higher low, another impulse, we have a higher high. That's the pattern. But we need to see, again, the two higher highs, the two higher lows in order to determine that we are in a trend. And it's important to draw a distinction between the trend and the individual moves within the trend. Because in a lot of places you go, you see people talking about trend and the impulse and corrective moves as if they were the same thing, and they're not, at least not when they're on the same time frame. As you'll see later, there is a relationship between the impulse and corrective moves on one time frame and the trend on lower time frames, and we're actually going to look at that quite some detail. But it's important that we draw a distinction between them. Just because price changes direction does not mean that the trend has changed. And it's important to remember that and keep that in mind. So now that we've defined the trend, when is the trend broken? Well, the trend is broken when the pattern's broken. So if we have an uptrend, again, the pattern is higher highs and higher lows. So how would we break this pattern? Well, you can have an impulse move that doesn't give us a higher high. Or we can have a corrective move that doesn't give us a higher low. So in the case when the impulse move fails to give us that higher high we're looking for, that is what we refer to as a failed impulse. And when the correction doesn't give us a higher low we're looking for, that's a long correction. If we look at it in the case of the downtrend, the pattern here, again, is lower highs and lower lows. And so if we get an impulse move that doesn't give us a lower low, then we have a failed impulse, and that breaks the pattern. If we get a corrective move that doesn't give us a lower high, but actually gives us a higher high, the pattern's broken. And that would be a long correction. So what does a failed impulse move look like? Well, a failed impulse move can give us something which kind of resembles an M or a W. And so in the case of the downtrend here on the left, we can see we have the last impulse move from the old trend. We have the last correction. And then we have our failed impulse move. We don't get the new lower low. Instead, we get a higher low. And then we end up with the first impulse of the new trend. And so you can see this kind of looks like a W. And one of the key things here is that, I guess you could call this the right leg of the W, is equal to or higher than the left. Now, in the case of an uptrend that's being converted or being broken, it's probably a better word to use, we again see the last impulse move from the prior trend. We see the last correction, and then we see our failed impulse. We should have gotten a higher high here. We did not. And so this is a failed impulse. And then we'll see the first impulse of the new trend that's taking over. So this is going to look like an M. And one of the characteristics here is that the right shoulder, I guess we can call it, is equal to or less than the left. Now, in the case of a long corrective move, we can also get something that looks like an M or a W. And so what we're seeing here is we have the last two impulses from the original trend and the last correction from the original trend. So this move should have been a correction if the original trend was to continue. And that means that it should have turned and started a new impulse move before we exceeded the starting point of the last impulse move. And since that did not happen, since we broke above that, we got a higher high instead of a lower high, this correction ran long. So the pattern of lower highs and lower lows was broken. Now this kind of looks like a W also, but the characteristic here is that the right leg tends to be, or tends to give you a lower low than the left leg. Now in the case of an uptrend, again, we have the last two impulse moves of the old uptrend, along with the last correction of the old uptrend. So what we should have gotten was a new correction. That new correction should have given us a higher low. So it should not have gone below the start of the last impulse. The start of the last impulse was at the last low. Instead, this correction went past that and gave us a lower low. So that was, again, a long correction that broke the pattern, that broke the trend. And this again looks like an M, but in this case, the right shoulder is higher than the left. Now, there's a couple of other things we can note about trends in general. If you do have a market that is trending, that means that price is making progress in a given direction. So if we look at this downtrend here, we can see how price is making progress downwards, and we're reaching successively lower prices. So what does that mean? Well, that means that the average of the price change associated with the impulse moves has to be greater than the average of the price change associated with the corrections. Otherwise, price would not be able to continue making progress to the downside. Again, if we look at it for an uptrend, it's the same thing. In order for price to make progress to the upside, the average price change associated with the impulse moves has to be greater than the average price change of the corrections. And of course, that means that in a sideways trend, the average price change for the impulse moves has to be about equal to the average price change of the corrective moves. And that way, the two of them cancel each other out, and price doesn't make progress in a given direction and instead just moves sideways. Now, does anybody have any questions on this so far before we start digging down? All right. So let's start looking at the relationship between trends on different intervals. Now, hopefully you all remember from part 1 of this presentation how we talked about candles being a sampling mechanism, because that's going to affect how we look at trend here. Trend is defined using the highs and the lows. And so when we defined our trend on a higher interval chart, we were using the highs and lows that were visible in the candles on that chart. But when we go to a lower interval, what's happening? Well, each of the candles on the higher interval represents a measurement period. And there's a whole bunch of price data that occurs during that measurement period. And we're throwing it all away except for 4 values. Those values are what price happened to be when the measurement period started, what it happened to be when the measurement period ended, and then the highest and lowest it got during the measurement period. So now when we go to a lower interval, we are reducing the size of our measurement period. And so the data that was contained in that higher time frame candle and was used to produce that higher time frame candle is now being divided up along or among multiple smaller candles. The measurement periods for those smaller candles are basically going to add up to the measurement period we used for a higher time frame to give us a higher candle. So the data points are being distributed now among multiple measurement periods. And that means that each of these smaller measurement periods is going to keep 4 values of the data that falls within their measurement period. And so it's going to keep the open, the close, the high, and the low. Now, the highs and the lows from the higher time frame candle are still going to be there. They will get pulled into some of these lower time frame candles that are replacing the higher time frame candle. But some of the data that was previously being thrown away when we produced the higher time frame candle is now going to be exposed by these lower time frame candles. However, this data that was thrown away because on the higher time frame, it wasn't higher or lower than the high and the low that were picked out and used for the high time frame candle. So we may see some new candle patterns with some new highs and some new lows, but all of those are going to be between the high and the low we saw on the higher time frame candle. So we have more data points that are being exposed that were previously being thrown away. So these new highs and lows are going to be bounded by the high and the low from the higher time frame. And since our trend is based on using the highs and the lows, the trend we find on the lower time frame is going to be bounded by the trend from the higher time frame. Effectively, it's going to be taking place inside of the trend from the higher time frame. So is everybody able to follow that? Is that making sense? All right. Since there's no questions, we'll continue to forge ahead. So the trend on the lower intervals is going to be bounded by the trend on the higher intervals. And this is a direct consequence of the way that candles are formed and the fact that candles are a sampling mechanism. So let's look at what happens as a result of this. So here we have a downtrend. This is going to be on our higher interval. And we can see here we have, again, impulse, correction, impulse, correction. And now we're in the middle of what we are assuming to be an impulse move. I say we're assuming it to be an impulse move because it has not yet given us a lower low, which is what it would need to do in order to prove that it's an impulse move. But that is what we are expecting. So we'll look at this last assumed impulse move. And what is that going to look like on a lower interval? Well, based on what we just discussed, on a lower interval, that impulse move is going to turn into a trend on the lower interval, because we're going to have more data points being exposed. We're going to have additional highs and lows being exposed, but all of those are occurring within the highs and lows of the higher interval. So we're going to see impulse and corrective moves on the lower interval. These are going to be smaller impulse and corrective moves than what we see on the higher interval. But these are going to form a trend. So the basic relationship then is that an impulse or corrective move on a higher interval becomes the trend on a lower interval. And we're going to see this again and again. Now, on the lower interval, because this is a trend, we can potentially find ourselves in two possible states. On the lower interval, we could be currently in a correction, or we could be in an impulse. And as we'll see, that affects things when you go to even lower intervals. Now, another way to draw this that may help make it clearer is if we do it like this. So again, we have our favorite downtrend, thanks to the miracle of cut and paste. And again, we're looking at the last move, which we're assuming to be an impulse move here. And this impulse move is represented by the big arrow. And that's made from the highs and the lows that we see on the higher interval. And then inside of that, we see, again, the smaller impulse and corrective moves, which are made from the extra candles we're getting on the lower interval and the extra data points that those candles are exposing. And that's giving us the trend on the lower interval. Now, in this case here, we're seeing that the trend on the lower interval matches the trend on the higher interval. They're both downtrends. And that's true whether we're in a correction on the lower interval or whether we're in an impulse on the lower interval. But we can get price on the lower interval going in the opposite direction from the trend on the higher interval. And that's basically going to happen like this. If we are in a correction on the higher interval, we have a downtrend, but now on the higher interval, we're in a correction, so price is moving up. And if we take that correction and we go to a lower interval, that is going to become the trend on the lower interval. And so now we see the trend on the lower interval moving in the opposite direction to the trend on the higher interval. Okay, so that's a key thing you've got to grasp. Key thing you got to remember. And now, of course, because we do have the trend on the lower interval, we could find ourselves in an impulse on the lower interval or a correction on the lower interval. And we can carry this even further. So we'll start again with our favorite downtrend. And in that downtrend, we are once again in the impulse move down. And as we saw before, that impulse move leads to a trend on what is now going to be our intermediate interval. So we now have a downtrend on our intermediate interval, and we could be in a correction or we could be in an impulse on the intermediate interval. So we'll take the easy case first. We'll look at the impulse move on the intermediate interval. So if we go to a low interval now, or a lower interval, what should this impulse move become? It should become a downtrend on that lower interval. And this is what we'll actually see. And so in this case, on all the intervals, our higher, our intermediate, and our lower, we are in downtrends. Now, in this bottom interval, again, we could be in a correction or we could be in an interval. But either way, we are in a downtrend on the lower interval. Now, let's go back and let's look at the case where, again, we have our downtrend on the higher interval. We're in the impulse move on the higher interval, and that becomes the trend on the intermediate interval. But on the intermediate interval, we're in a correction. We go down to our lower interval, what's that going to become? That's going to become an uptrend. And that's going to end up looking something like this. So this correction on the intermediate becomes the trend on the lower interval. And that means on the lower interval, we could be in an impulse move upwards, or we could be in a corrective move. But in this case, the trend on the lower interval is opposite to the trend we see on the higher intervals. So let's see what this looks like on a chart. So here we're going to start with our higher interval. There's a chart of the NQ. It's a little squeezed to fit it on the screen here, but we can see we have the impulse move here marked. We have a corrective move. We have another impulse move. Over here, we have a long correction. But then the trend reasserts itself. And we get another impulse move up. And it keeps chugging away. So we're going to go and look at this move here between these two vertical lines. On the higher interval, it's just a nice move upwards. But as we'll see, when we go take a step down, we'll go to a 240 since that's the next step down from a daily that most people use. We'll see what happens. Okay, and here it is. Now we're on the 240. And what do we get? We're now getting impulse and corrective moves. So as we saw, we had the impulse move on the higher interval, and that turned into the trend when we went down to the lower interval. So the relationship we're looking at actually holds. Now this is a fairly clean example, and I could show you other nice clean examples, but I don't want to go cherry picking data. So let's look at something a little bit more common. Price, or I should say the price signal, has noise in it. And so sometimes we'll see things creep in here like sideways moves or brief interruptions in the trend. We actually saw a brief interruption in the trend on the higher interval when we had the overshoot there and we had the long correction. But the trend reasserted itself on the next move. So let's look at an example that's not as clean. So here we're on RTY, we're on a daily chart. And on the daily chart, we have a nice clean impulse move down here. And that's followed by what's probably a corrective move here, but it doesn't matter. We have a move on the high time frame. And that move on the high time frame is going to become the trend on the lower time frame. That's the key. So let's take a look at this one here first, move number one. So when we go to move number one here, we can see how this turns into moves again, impulse and corrective moves. Now here we get some noise, and this does turn into a bit of a sideways move, but then the trend reasserts itself and down we go. And actually over here in this sideways move, you can actually see a bit of an M pattern. But again, the general relationship held in that the move we had from the high time frame became the trend on this lower time frame. Now, for those who are wondering, the red dots here are marking the swing highs and the green dots are marking the swing lows. And that way you can see how he selected the points, or how the starting points for the moves and the ending points for the moves were selected in accordance with the rules we gave earlier. Now here's move number two. And again, on the higher time frame, that was just a clean move up. And down here, when we go to the lower time frame, again, we see it start turning into a trend. We see the impulse move, the corrective move. We come back here, corrective move, and then here we get a failed impulse move, We start to get some sideways motion, but the trend then reasserts itself and finishes. So again, the general relationship holds, but as you go down, the data does get noisier. You do see interruptions in the trend like this more often. But overall, the relationship still holds, because we still have to get to the same place in the end that we saw in the higher time frame. And anything we get here has to take place within the candles on the higher time frame. And it is all bounded by the highs and lows of the candles on the higher time frame. So because of this relationship between the candles on the higher time frame and the lower time frame, and because of the fact that we're using the highs and the lows for defining our trends, our trends on the lower intervals must conform to the trends on the higher intervals. They have to. Okay. That is because of the nature of the way the candles are constructed and the way trends are determined. The only time any of this changes is when you're at the bend at the end of the trend. And that's when you'll see the nonconformance on the lower interval, which will then carry through to the higher interval, and you'll see the trend broken or changed on the higher interval. So in the example here, we have our downtrend and we have a correction. And this correction is very close to breaking the trend here. If it goes above this high here, then it would break the downtrend. So what we're expecting to happen here is that's going to reverse and turn into an impulse move down. And on the lower time frame, we have our uptrend roaring along here. And that would then have to change into a downtrend as well if this downtrend is going to continue. Does anybody have any questions on this before we move on? Is everything fitting together and making sense? Okay. So let's start looking at trying to detect a change in direction quickly. All right, this is different than detecting a change in trend. What we're trying to do here is detect the change from an impulse move to a corrective move, or vice versa. Now, generally speaking, if you are in an upward move of some sort, it doesn't matter whether it's an impulse move or corrective move. But whenever you're in an upward move, demand is going to be holding and supply is going to be breaking. Otherwise, you can't make progress to the upside. Similarly, if you're in a downward move, supply has to hold and demand has to fail. Otherwise, you're not going to make any progress to the downside. So for our downward move, or our upward move, what does supply failing really look like? Well, the most obvious one is if you actually have a supply zone and it's broken. Okay, price goes through it. However, we also have the swings that we've talked about and the base highs that we've talked about in part one. Now, swings, these are points where price changed direction. And from the law of supply and demand, we know there had to be an imbalance between supply or demand at that location. What we don't know is how much of an imbalance remains after the change in direction that price makes. So we know that odds are good, that there's an imbalance there, but we just don't know how big an imbalance it is. But if price comes and closes above our swing high, then that supply, however much was there, is broken and is gone. Now, in the case of a base high, we had a base, and we know that whenever we have a base, we have supply above the base and we have demand below the base. And that supply and demand is working together to trap price within the base. But eventually we get a leg out. And if the leg out's to the downside, that's going to eliminate the demand that was keeping price within the base. But the supply is left behind. And that's what gives us the base high. The reason the base high did not get turned into a zone was because we didn't find some of the other things that we look for that give us some confidence that there is a significant imbalance remaining at that location. But that doesn't mean there isn't a lot of supply there. It just means that we don't know how much supply is there. So if we get price closing above a base high, then that is going to mean that the supply that was there has now been eliminated. So these three things are all objectively failures of supply. And we can find those all on a chart in an objective way. Now, the flip side of the coin is demand. What does it look like for demand to fail? And so, of course, the obvious case is for a demand zone. If price goes through the demand zone, then the demand zone is broken. That would be a failure of demand. And then everything we said about swing highs, we can just flip it and apply that to swing lows. And the same with base lows. So again, a swing low is a point where price changed direction. So there had to be an imbalance between supply and demand at that location. But again, we don't know how much is left after price changed direction and left that area. With the base low, again, we had a base. So we know supply above, demand below, price trapped in the middle. But this time when we got a leg out, the leg out was to the upside. So the supply was eliminated, the demand was left behind. This didn't get turned into a zone because there was something missing. We were not able to get a, what would you call it? A warm fuzzy, that there's a lot of demand left there. We didn't have any way to estimate how much demand was left. So we did not turn it into a zone. That doesn't mean that there's no supply, there's no demand left there. It just means that we don't know how much is there. And so we don't know how to treat it. So if we get a close below a base low or a close below a swing low, that's a failure of demand because we know there had to be some demand there. We just don't know how much. But when you get the close below, that demand is gone. There's no more unfilled orders there. Now, generally speaking, in an upward move, regardless of whether it's an impulse or corrective move, a single failure of demand indicates that the move may be changing from up to sideways. We require 2 consecutive failures of demand to indicate a reversal taking place. And if you think back to some of the charts we just looked at with the NQ and the RTY, we saw how we got a single failure and we had that sideways move, and then the trend reasserted itself. and continued onwards. So the single failure indicated that we were potentially changing. We did go into the brief sideways move, but then the original trend resumed. If we had had 2 consecutive failures, then we would have had a reversal taking place. And again, for a downward move, we can just, again, flip this off. So in an upward move, single demand failure indicates we may be moving to a sideways move, and 2 consecutive failures of demand is going to give us a reversal. In a downward move, a single failure of supply indicates that we may be changing to a sideways pattern, a sideways move, and the 2 consecutive failures indicates a reversal of the move. Now again, we are talking about changing the move within the trend. This is not a change in the trend itself. We're just moving from an impulse move to a corrective move or vice versa. And a lot of the times you hear people talk about trend, they confuse this and they conflate the changing of the move with the changing of the trend when they're actually 2 distinctly separate things. So let's use our base highs and lows to try to give us a faster indication of a change in direction. So in this particular snippet of a chart here, we have our swing highs marked by dots over the candles, the red dots, and swing lows are marked by green dots. There's actually one right down here on the bottom of this big red candle at the very bottom. That dot happens to be covered, though, by this dashed line. This dashed line is what we are using to indicate a base low. So here we can see we have several base lows. And over here, we have these magenta lines. These represent base highs. Now the candles with the yellow ticks, these are the start of bases. So this first one here, we can see a base. It starts with a basing candle, which is the candle with the yellow tick. And this is a basing candle because the candles that follow it close between its high and its low. The leg out that breaks this base is this one over here. This is the first candle that closed outside the range of this basing candle. And since it closed to the downside, that meant that the demand, which had price trapped, is gone, whereas the supply, which had been helping to keep price trapped, is still there. And so we have the magenta line here, which we call the base high, showing where that supply may be. Over here, we have the cyan lines. Let's look at this one here on the right. And again, our base starts with the candle with the yellow tick mark on it. And we can see this is a basing candle because we've got 3 candles that follow it that all close between its high and its low. The leg out is the big green candle at the very right. And since it broke out to the upside, the supply that was holding price within this base is gone. But the demand that was propping it up is still there. And so we put the cyan line at the bottom of the basing candle to show the approximate location where that demand may be. So in this example, on the left here, we see price is steadily moving downwards. And then he reaches the bottom here, he forms a base. And then we get a leg out to the upside. So there's several different ways that we can interpret this. For starters, in order to get this base low, what had to happen? You had to have the leg out to the upside. And that meant that supply, which had been holding price within the base, is gone. And so that's our first failure of supply. Now this candle coming up here also closed above this base high here. So that supply is gone too. Personally, this base high is so close to the top of our basing candle here that I would likely consider that to be the same area of supply. So I would only count that as one supply being broken, but more aggressive traders would count that as two and start looking for a way to potentially go long here, depending upon where they are in the trend. Now, somebody who's more conservative, they may wait until they have another indication of supply being broken. And that could be this second base low forming here. And that second base low doesn't happen until this base gets broken. And it's hard to tell from this picture whether it's this green candle or the next one that acts as the leg out. But in either case, this base gets broken to the upside. And because it's broken to the upside, that means the supply that was holding down price, keeping it within the base, is gone. That's our second failure of supply in this example. And the demand remains, which gives us the base low marker down here. So that could act as the second failure of supply. And then a more conservative trader could start looking for a way to get in, potentially to go long. And for those who are even more conservative, when they get this leg out candle here, that would also break this base high and this swing high. So that's how you can use these to try to get a quick indication that trend may be, or not trend, but you may be switching from whatever move you're currently in, whether it be an impulse or corrective move, to the other. So now that we've looked at changing from an impulse move to a corrective move or vice versa, let's start looking at trend and actually changing trend. So in an uptrend, we have higher highs and higher lows. Basically, if you violate that pattern, then the trend is changing. Now, when we're talking about higher highs and higher lows, what are we talking about? We're talking about the moves that we've seen earlier, the impulse and corrective moves, and the swing highs that are used to determine the changing from an impulse move to a corrective move. So in the trend, we have an uptrend. Our impulse moves are giving us higher highs before they turn into corrective moves. And the corrective moves are giving us higher lows when they turn back into impulse moves. And so whenever that pattern is broken, then the trend is broken. Now we can just flip this over again for downtrends. We expect our impulse moves to give us lower swing lows than prior impulse moves do before, again, changing into a corrective move. And we expect our corrective moves to give us lower highs before they change into impulse moves down again. So again, the highs and the lows here, we're talking about those moves. And a single violation of the pattern generally indicates we're moving into a sideways trend. And two violations in succession generally indicates a reversal of the trend. And so if we look at that graphically, Here we have an example of a downtrend being converted to an uptrend. So we have our impulse moves down, our corrections up, impulse down, corrections up. And then here we get a long correction. This correction exceeds the previous high, where a correction turned into an impulse. So that gives us one break. So at this point, we could be getting ready to go sideways. If this impulse continues upwards and gives us a second break, where we get above this transition point here, that gives us our two breaks, and we have a reversal taking place. The more typical case is we'll get the first break, we'll get a pullback. So essentially, this long correction acts as an impulse move in the new trend. We get a corrective move in the new trend, and then we get another impulse move in the new trend, and that new impulse move gives us that second break. In the case where we're going from a downtrend to sideways, it's the same kind of things we saw up above. We get the long correction, which gives us the first break. But after that, we can never get the second break. And the trend doesn't reassert itself, so we never get the new low. And price just bounces back and forth sideways in a channel. So hopefully that's making sense to everybody. Before we move off the topic of trend, does anybody have any questions? Hopefully all of this is fairly clear. Let's talk about curve. There are actually multiple definitions for curve out there, some of them having nothing to do with each other. So we're going to have to define curve to be what we want it to be and to be what we want to use it for. So what exactly is curve? Anybody want to venture forth with the definition here? We'll see how many folks are still awake. So nobody wants to put forth a definition of what curve might be. Okay, we have a definition here. This is a good one. Price extremes on the higher time frame. Okay. Yeah, I've heard people define curve as being like the playing field, the area where we expect price to stay in. Some people define it as giving us, wholesale prices and retail prices, or basically a way of determining whether price is high or low. There's all sorts of things. Well, the next question is, what do we want it to be? Okay, what is it that we would like to get from curve? Well, I want something that's going to tell me when the odds of a change in price direction are increasing, because that would actually be useful. And I could go and use that in planning trades. And that's the way we're going to look at it here, and that's the way we're going to use it here. So how do we know when the odds of a change in direction are increasing? Well, the odds of a change in direction go up when the move on the current interval comes into conflict with the trend. So for instance, if we're in a downtrend and we have our lower highs and lower lows, and we're in a correction, and we are approaching the point where the correction is going to break the pattern, then if the trend is going to continue, price is going to have to change direction, and we're going to have to get into that next impulse downward. So since the trend is your friend until the bend at the end, the most likely thing to happen is for the trend to continue, which means that the odds of price changing direction go up as our corrective move starts to get close to breaking the pattern for the trend. Now, the odds of price changing direction also go up when price reaches a supply or demand band, especially if that band comes from a higher interval. And the odds of price changing direction go up when we reach a point where price is close to a location it changed direction in before. If you think about it, if you're in a sideways trend, what's happening? You're in a channel, a sideways move. We see here what happens. Price gets close to where it changed direction before, and it changes again and again. Down here, we see the same thing until finally the sideways move is broken. At any given point in time, most markets are moving sideways. And as we just saw, price turns near where it did previously. Now, if we are in an uptrend, let's say, we expect impulse moves to give us new highs, but corrective moves have to give us higher lows. So that means we expect them to turn before they reach the prior low. And the closer they get to the prior low, the greater the probability that price will turn. So we can use that to help give us an idea that the probability of a turn is increasing. And if we just started a new impulse move, often after you get a change from a correction to an impulse move or vice versa, price will want to retest the level at which the change in direction took place. And so if we see price pulling back to that point, the odds of price reversing again and continuing on with the impulse move go up. So we can go and we can use this to get an idea of where the odds are increasing for price to change direction for when we're in an uptrend here. If we do this in a downtrend, we can do something very similar. Again, once we get our impulse down and we have our confirmation that we've started the next move down, price is pulling back to retest areas near the start of that impulse, have a high probability of turning and resuming the impulse move down. And if we are in a correction, again, the closer the correction gets to the point where it would break the trend, the higher the probability of the correction ending and transitioning into a new impulse down in this case, because we're in a downtrend. So here's what we're going to do to draw the curve. For an uptrend, if we're in a correction, The point at which we transition from the impulse move to the correction is going to be our top of the curve. And the bottom of the curve is going to be the last point where we transitioned from a correction to an impulse. And so, as you can see right now, our top of the curve and our bottom of the curve are the transition points where we have transitioned from one kind of move into another. Now, these points, the swing highs and swing lows at these points are often called candles in control. And you'll probably hear me refer to that later. And so once you've determined where your top of the curve and where your bottom of the curve is, you can then break the curve up into pieces to reflect the probability or the change in probability of a zone holding if price returns to it in that area. And how many pieces you break the curve up into to reflect, the changing of probability, that's really up to you, and you can determine that through back testing is really what it comes down to. In these examples here, we've broken the curve up into three pieces. You've got high on the curve, low on the curve, and the area in the middle, often referred to as no man's land. And so the idea is that zones which are high on the curve or low on the curve have a higher probability of holding. Now, with that being said, we have to point out one thing here. All right. We take the bottom example here. Okay, we've just gone into an impulse move. Because we started into an impulse move here, we would expect zones that are in this bottom section of the curve. They would be demand zones, and we would expect them to have a higher probability of holding. Supply zones in this area formed during the corrective move, we would expect those to fail. Okay, because they're in the wrong part of the curve for a supply zone to hold. So the bottom of the curve is for when price is moving up, demand zones are very likely to hold. We've just made our transition from a corrective move to an impulse move. We will see some pullbacks to test things as we go. But again, demand zone should hold well here. And since we're in an upward move, we expect demand to hold and supply to fail. Now, when we get up here high on the curve, we actually expect supply zones up here to fail as well. Why? Because this is an impulse move, or assumed to be an impulse move. And if it's an impulse move, it has to give us a new high, which means it's going to have to break the top of the curve. We can't have an uptrend without breaking the top of the curve. But if the trend is to break, where is it most likely to do so? In a supply zone up here, high on the curve. And indeed, when price does get up here, before it finally breaks through and gives us that higher high we're looking for, it may indeed give us bounces off of zones up here. But those zones, if you were to actually trade them, those would be counter trend trades, and you'd have to be careful about those. But in an uptrend, we always expect the top of the curve to be broken, because that has to happen in order for us to have a trend. And in the upper example, where we're in a correction in the uptrend, the same still holds true. If this trend is to continue, then the top of that curve has to be broken. And a correction can end at any point as long as it doesn't break the prior low in this case. Because in an uptrend, we have to get higher lows on a correction. So the farther down we go, when we get into this lower part of the curve, the chances of demand holding are higher. And then if we do start an impulse move there, again, we expect to stop, to break the top of this curve. And of course, for a downtrend, you just flip the whole thing. So again, we're getting the last 2 points where we had a transition, where we had a change from one kind of a move to another, from an impulse to a correction or a correction to an impulse move. And that's going to be the high and low for the curve. And then you have to look at where you were. If we're in an impulse move here in a downtrend, we expect the bottom of the curve to be broken eventually. Otherwise, price can't make progress in that direction and you don't have a trend. And if price does pull back to a supply zone in the top of the curve here, we expect those to hold so that the impulse move can continue. Demand bands in the bottom, near the bottom of the curve, if the trend is going to be broken, that's likely to where it's going to happen. And again, you may get a fight as price tries to break through the bottom of the curve and the demand bands near the bottom of the curve. But if the downtrend is to continue, the bottom of the curve has to be broken. In the bottom example here, we can see price is actually in a correction at this point. And again, we expect the bottom of the curve to be broken. We expect our downtrend to continue. And since we're in a corrective move, a correction can end at any time as long as we don't exceed, in this case, the prior high. And the closer we get to that prior high, the more likely it is for price to change direction and the correction to come to an end and a new impulse move start. So this is how we're going to do the curve. And depending on where we are on the curve, it can give us an idea of what the odds are for getting a change in direction, what the odds are for our zones to hold, and what kind of a bounce we can expect off those zones too. If it's a counter trend bounce, we don't expect the bounce to be very big. So if you're trading those, you may want to adjust your targets accordingly. Only go for 1-to-1s or 2-to-1s type of thing. And if you're going with the trend, that's when you can start looking for the bigger winners. So how are we going to find this curve? How are we going to draw this curve? Well, as I've said before, we're looking for the last 2 changes in direction we had, the last 2 points where we had an impulse move change to a corrective move or vice versa. And we're going to use those as the boundaries for our curve. And drawing the curve this way, we know what to expect when price gets near the top or the bottom of the curve. If we're in a sideways trend, then we're expecting price to close. We're expecting price to turn close to where it previously did. And that's typically going to be near the top of the curve and the bottom of the curve. And if we're in an uptrend, we expect price to turn before reaching the bottom of the curve, and we expect it to go beyond the top of the curve. Because again, we can't have an uptrend without breaking the top of the curve. For a downtrend, prices should turn before reaching the top of the curve, and we expect it to eventually break the bottom of the curve, because we can't have a downtrend without breaking the bottom of the curve. And we know that swing highs and lows are associated with each of the direction changes. So we're going to use the swing highs and lows with the rule of 2 to find the prior direction changes. And while we're going to talk through this with words now, we're actually going to look at some graphic examples of this later. But basically, this is very similar to what we saw in part 1 when we were looking for the changes for impulse moves into corrective moves and vice versa. So to find the top of the curve, we're going to start from current price, and we are going to be looking at swing highs. And we're going to go up and to the left without cutting through candles, looking for a swing high that has at least 2 lower swing highs on either side of it. And this is going to be the candidate for the top of the curve. And we would really like this to be a significant turning point. So an added check that we're going to do is that we are going to look for the swing low immediately prior to our candidate for top of the curve. And then we're going to want to see price to the right of our candidate go below this swing low. And that basically helps eliminate some anomalies and some noise that can creep in or cause issues, particularly on lower time frames. So now that we've got the top of the curve, we're just going to flip it and do this whole process to look for the bottom of the curve. So we're going to start with current price, and we're going to be looking at swing lows. We go down and to the left looking at swing lows without cutting through candles. And we're looking for that swing low that has at least 2 higher swing lows on either side of it. And that's going to be our candidate for the bottom of the curve. And again, to try to eliminate some noise and other stuff, we are going to look for the swing high immediately prior to our candidate for the bottom of the curve. And we want to see price on the right of our candidate go above that swing high. So let's see what this looks like now. So on this chart, we actually have the curve marked in blue. The bottom of the curve is marked with 0%. Top of the curve is marked with 100%. And we've divided the curve up into 3 pieces. We have swing highs marked with red dots above them. And we have swing lows marked with green dots below them. So let's go through the process we just discussed and find the top of the curve. So we're going to start here on the right with current price. And we're going to go up and to the left without cutting through candles, looking at swing highs. And we want a swing high that has 2 or more lower swing highs on either side of it. And we find this guy right here. He's definitely got several lower swing highs to his left. And to his right, he has several lower swing highs as well. So now that we found him, he's our candidate. To make sure that he is significant enough of a swing high and a significant enough of a turning point, we're going to now look for the swing low immediately prior to our candidate. And we find that over here. Oh, doggone it, I'm sorry. I clicked the mouse when I shouldn't have. So again, here's our candidate. And here is the swing low immediately prior to our candidate. So our final check, our final step now is to see if price to the right of our candidate went below this swing low. And we find that it did not. So that means this guy does not qualify. So now we continue going up and to the left without cutting through candles. And we end up all the way over here where the red arrow is. And this guy's got lots of lower swing highs to his right. And he's got at least 3 lower swing highs to his left that we can see. So he meets those requirements. So now we do our final check. We find the swing low immediately prior, which is right here. And to the right of our candidate, we see that price went well below that swing low. So this swing high meets all of our requirements, and he becomes our candle in control high, and he becomes the top of the curve. So now we need to find the bottom of the curve. We again start with current price, working down and to the left without cutting through candles, and we are only looking at swing lows. So we look at this guy. He's got higher swing lows to his left, but not to his right. So he's disqualified. We see this guy here. He's got multiple higher swing lows to his right, but not to his left, so he doesn't work. We come to this guy. He's got higher swing lows to his right, but he only has 1 to his left, so he doesn't qualify either. This guy here has no higher swing lows to his left, so he obviously doesn't count. And we come all the way down here. This guy does have multiple higher swing lows to his right. And to his left, he does have 2 higher swing lows. And while it's drawn, the way the chart is scaled, it looks like this swing low here is the same as our candidate. It turns out that in actuality, this guy is higher as well. So he actually had 3 higher swing lows to his left. So at this point, we have a candidate for the bottom of the curve. Our final check, we go look for the swing high immediately prior. We find this guy here. And did price to the right of our candidate go higher? It sure as heck did. So this ends up being the bottom of the curve by the rules. Now, some people may feel more comfortable using this one down here because this is a much cleaner cut case. And he has multiple higher swing lows on either side of him. And you could certainly do that. But just going by the rules, this one qualifies. So let's go look at another case. So we start with price, with current price, which is over here. We work up and to the left, looking at swing highs. And we find a swing high right here. This swing high has multiple lower swing highs to his right, and he has multiple lower swing highs to his left. So now we have to check the swing low immediately before him, which is this one right here. Does price to the right of our candidate go below this swing low? Sure does. So this guy meets all our requirements. He becomes the top of the curve. To find the bottom of the curve, start with current price, go down looking at swing lows. You get a swing low here. He doesn't have any higher swing lows on either side of him, so he doesn't count. We reach this guy here. He has multiple higher swing lows to his left, but he only has one to the right, so he doesn't count. So we come across without cutting through candles. We come down to here. This swing low doesn't have any higher swing lows in his left, so he doesn't count. The next one down doesn't have any higher swing lows on the left. We reach this guy down here. He's got multiple higher swing lows on his right, and he's got at least 2 higher swing lows on the left that we can see. So he meets the requirements. Now we have to check the swing high before him. We come up to here. And did price to the right of our candidate for the bottom of the curve go above this swing high? The answer is yes, it did. So now with all the conditions met, this becomes the bottom of our curve. So this would be the candle we control low, as it's referred to. This would be the candle we control high. And we have our curve drawn between the two. And by convention, we have it broken into 3 parts. Any questions about that? Was everybody able to follow that okay? Does that seem to be difficult? Okay, so far so good. All right. Okay, one question that always comes up is how good are the zones or bands found using the objective approach described? Well, the only way to really tell is to backtest. Now, one of the problems with backtesting is if you use the traditional approach, is that you can't see the performance of the bands directly. With the traditional backtesting approach, you're basically taking your trading system, you're going to a point in the past, and you're trading your system against what the market did at that time in the past. And you can choose points in the past where market behavior was similar to what it is today, and that would give you an idea of what to expect trading your system today. You can also go to points in the past where market behavior was very different, so you can see how your system would perform under, various other kinds of market conditions. But since you're trading your system and you're looking at the results through the results of your trades, that makes it difficult to determine what the performance of the zones or the bands were themselves. Why is that? Well, if you remember from part 1 in the supply and demand trading process, there are multiple stages you go through. The first stage you go through is finding your bands, your zones. Stage 2 is filtering the zones that you found. Stage 3 is where you apply a strategy. And then stage 4 is where you actually go and execute the strategy. So you're trying to measure the performance of the bands or the zones, but you have all of this other stuff between the bands and the final result, all of which can directly influence the final result you see. So if you have good bands but bad filters, You may be throwing away good bands that you shouldn't be, and that'll affect your performance. And the problem had nothing to do with the bands themselves. If you're using the traditional approach, you have to link the strategy to the bands. And so now the performance of the bands is seen through the lens of how well the strategy performed. If the strategy is inappropriate for the market conditions, the results are going to look bad. And again, it may have nothing to do with the bands at all. It could just be an inappropriate choice of strategy. And then finally, you're also looking at the performance of your bands through the performance of the trader. And so if you have somebody who's a stellar trader, they can make up for a lot of the inherent flaws that may be in their trading system and make things look good. Or if you have a poor trader or a mediocre trader, that's going to give you different results. And again, that has nothing to do with the bands themselves. So to measure the performance of the bands, we would like to isolate the performance of the bands. And so we have developed a backtesting methodology that allows us to do that. We have a 2-hour presentation on that. Well, it's actually a bit more than 2 hours. It's up on YouTube. It's on backtesting. It discusses both the classic backtesting approach and the approach that we use, and the advantages inherent in the approach we use, which is why we use it, of course. However, our approach is strictly limited to the supply and demand trading methodology, whereas the classic approach works with just about any trading system you can come up with. So if you're interested in finding out exactly how we backtest, that's the video you want to go see. So we're going to be looking at backtest results here. And we're going to be using certain metrics to measure the performance of the bands. One of them is what we're calling the success rate. So we're going to define a test period. Let's say for the sake of argument, we're going to define August of 2020 as our test period. We're going to look at all the bands that formed during August of 2020. And we're going to look at price bouncing off those bands. And we're going to be looking specifically at the biggest bounce we get off of each band before the band is broken or before the test ends. And our success rate is going to be the percentage of the zones that give us a 1-to-1 or greater bounce. So if you have a zone that's 10 points wide, it has to give us a 10-point bounce in order to reach that 1-to-1 ratio and be considered successful. So that is going to be the success rate. The next metric has several names. Points in play is an easy one. It's also known as points available for capture. But basically what it is for all the successful bands in the test, we're going to take the biggest bounce off of each of those successful bands or successful zones, and we're going to add up those bounces. And then we're going to subtract out the width of each failing zone. What we're left with is an indication of how many points you could, in theory, be able to capture if you were the perfect trader. And this assumes you're trading one contract if it's futures, one share if it's stocks. But it's indicative of what is theoretically possible. Now, if you remember, when we talked last week about the supply and demand trading methodology, the way we make our money is off of those bounces. We're playing those bounces, so the bigger the bounce, the more money we can potentially make. And so here, what we've done is we've added up all the bounces from the winners, and we've subtracted out the losers. And so the result is what is left on the table and is the theoretical maximum that you could make. So are you actually going to achieve that number? No, not unless you're maybe psychic or something. But it gives you an objective measure against which you can compare. So for instance, if you're optimizing your trading system and you're changing the way you find zones, you could use that to see if you've improved, or as one measure of any improvement you may have made in your zones. So that's the points in play. The final thing we want to look at is fractal behavior. How consistent is the performance of the zones that you found as you go across different intervals or markets? Different markets have different personalities. And so they behave differently. And what works for one may not work so good for another. Similarly, if you go from one interval to another, do your zones still perform the same? Do the zones you find only work well on the high time frames? Or do they work equally well on all time frames? Or what about chart types? How do they work on share bars versus tick charts versus time-based charts? Now, if you're getting fractal performance, that means that the results should be the same, pretty much on all of them. Now, it can be shown that markets are not fractal. That's not too hard to do. Markets do not meet the mathematical requirements to be fractal. But it can also be shown that as long as you have sufficient volume, markets will exhibit fractal-like behavior. So that's really what we're looking for here, is we want to get fractal-like behavior from our zones. So let's see what we can see. So we'll jump out of here. And we'll look for, here we go. What we have here is some data from 2018. We have CL on the left and Q on the right. And this first set of charts is showing us the success rate. And we're seeing that by month, and then we have an average across the year at the end. And at the end of part one, we actually talked about drawing zones. And we gave a way to draw narrow, medium, or wide zones. And we can look at how well those performed here. And so that's what's showing. And so we can see here on the 60-minute chart, we'll look at oil first here on the left. I'm going to be looking primarily at the averages. We can see here that wide zones perform better than narrow zones, and the difference was actually quite substantial. Our success rate on the wide zones was 46%. That's not bad. The narrow zones, the success rate was lower, but then again, the risk is lower as well because they're narrower zones. And the medium came in right in the middle. If we go look at the 15-minute chart, we can see that this does not vary much from what we had on the 60-minute chart. You know, the narrow zones on the 60-minute chart was the 38.5. We'll round that up a bit. You know, here it's 37.4. So you're talking, you know, a 1-point difference. That's not much at all and could well be within the margin of error. So a slightly larger gap here in the medium size zones. And we actually had the 15 outperform the 60. But again, it's not a huge difference. When we go to the wide zones, the difference is very small, less than a point. And when we go down to the 5-minute, what do we see? The narrow zones, 38. Again, very little difference between the 5 and the 60. We actually get a bit more of a difference with the medium-sized zones. And the difference between the 15 and the 5 on the medium is not that big. It's a little bit bigger when you go to the 60. But still, you know, there's nothing outrageously different here. And then when you go to the wide, again, it's all very close, very consistent. So this is fractal-like behavior. Now, is this limited to just CL? No, we're going to look at NQ now. And NQ is a very different market than CL is. CL is oil. That's the futures contract for oil. NQ is the futures contract for, you know, the NASDAQ. Now, if we look over here, again, we see pretty much what we expect based on what we saw from oil, in that the wide zones perform better than the narrow ones, with the medium being in the middle. But if we look at these, interestingly, there's not a whole lot of difference, again, between the success rates on oil and the success rates on the NASDAQ. On the narrow zones, it's a very small difference. There's a bit of a difference in the medium and in the large, but again, these are not, you know, groundbreaking differences. And as we go and we look on the lower intervals, you know, again, there's little differences, but nothing major between oil and the NASDAQ. So what we're doing works pretty well across two very different markets. And if we look just within, you know, the NASDAQ, again, there's no huge earth-shattering differences. You know, if we look at the difference between the 5 and the 15, especially for the wide zones, there's not a whole lot of difference here. Now, while we're looking at success rates, we'll come back to look at points in play in a few moments. Let's go look at 2019 and see if this holds for 2019 as well. And again, if we look at oil, again, not a lot of difference from what we saw for 2018. And as we go down to the 15, this time around, we see the 15 outperforming the 60, but not by very much. Again, the differences are pretty small overall. You know, if we look at the wide here, the best performer on the 60, it was 45%. The 15 was 47. Again, not a big difference. We go down to the 5, it's down 45.5, roughly speaking. And again, there's not a lot of difference between the others as well. So again, we're seeing fractal-like performance here on multiple intervals. And if we go again and look at the NASDAQ, we again see the fractal-like performance here. Here, the 15 again outperformed the 60, but again, it's nothing dramatic. Well, on the narrow zones, it's getting to be a little significant, but on the others, there's not a whole lot of difference here. And between the 5 and the 15, again, there's not a whole lot of difference either. And when we compare what we're seeing on the NASDAQ against oil, if we look at the 5, again, there's not a lot of difference between them. And on the 15, not a lot of difference between them. And on the 60, again, not a lot of difference between them. Let's look at 2020. Now, again, we look at oil. On the 60, oil did pretty well. They actually hit 50% here using the wide bands. And as we go down, again, not a whole lot of difference. Roughly speaking, if you're using the wide, which seems to be the best performer, you're looking pretty much mid-40s, occasionally getting, better. But the differences are pretty minor. And if we go and we look at the NQ, what do we see? We see pretty much the same thing. We're mid-40s, mid-40s. Here, you're close to mid-40s also. You round that up to 43, you're mid-40s. And again, when we look, the differences between the performance on oil and NASDAQ are not dramatic. There's slight differences. Again, though, the differences, there's nothing dramatic there. So we've been looking at, lower time frames here. Let's go look at high time frames. So we've had to increase our test period here so that we would have enough zones to get something statistically significant. So now we're looking at 5-year periods instead of monthly periods. But even so, doing that, again, if we look at the wide, that's the easiest one to compare. That was the best performer on all of them, right back in the mid-40s. Come down here, 240-minute chart, mid-40s, 480, mid-40s. The only place we see a bump is on the daily. And the daily gives us a decent bump, and it's in our favor. So, hey, I'm not going to complain. When we go back to the weekly, right back in the mid-40s. If we look at NQ, same thing, mid-40s. 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 And we get a little bump on the daily. Not quite as big as what we got on oil. But still, hey, we'll take it, right? And then we're close to mid-40s again right here in the weekly. So we've essentially achieved fractal performance or fractal-like performance. And you can see the results were also pretty consistent year to year. We looked over 3 separate years here. So now let's go look at the points in play. Let's see. Let's trying to fit everything here. Let's do that. Okay, can everybody read that okay? Is that too small, or is that going to be okay? Let me try going up one more. That's a little too much. So can everybody see that okay? All right, no complaints, so we'll go with it. So here's the points that are being put on the table. Now, for those not familiar with futures, Futures are a leveraged asset. And so a 1 point change in futures is not going to correspond to, you know, a $1 change that you'd have like in stocks or something. A 1 point change in oil, you know, which is essentially the change of price in oil. So if you have a $1 change in the price of oil, that's going to correspond to $1,000 change in you know, cost and what you can potentially put in your pocket. Whereas the NASDAQ, it's only $20. So over here, you're going to see the point numbers for oil are going to be a lot lower. But we can see here how you draw your zones, narrow, medium, or wide, has a direct effect on the number of points that you can possibly capture within a month. And you can see what the average is here per month. And I have it translated here into dollars. So in 2018, on a 60-minute chart, the bounces off the zones, off the successful zones, after subtracting out all of the losers, all of the losing zones, there was theoretically as much as $18,000 a month trading just a single oil contract on the table, which you could potentially try to capture with your trading system. Now, this is for all of the zones during the test period. And, you know, none of us is going to be able to sit there and trade 24 hours a day for the entire month. So we're not really going to be able to capture that much. So we're going to be trying to capture some percentage of that. And we'll look a little bit later about how the hours you trade can actually affect what you're able to capture. But this is theoretically what is on the table on average each month, trading oil on a 60-minute chart. Now, the interesting thing here is that as you go down the lower time frames, you get more and more potential points that you can capture, more points in play. So on a 15-minute chart over the same time period, you had an average of $41,000, almost $42,000 on the table per month that you could try to capture. And as you go down to a 5-minute chart, that number more than doubles. So what we're seeing here is that it is possible to make more money on the lower time frames. And if you think about it, that makes sense. Because how do we make our money? We make our money off price movement that happens when price bounces off of one of our zones. If you're playing up on a daily chart, you have all those nice big candles, but price doesn't go, you know, in a straight line for very long in the markets. So there's a lot of price movement that you can't see on a daily chart because it's hidden inside those nice big candles. And if you can't see it, you can't trade it. So as you go to lower time frames, more price movement is exposed to you. More price movement means more potential profits. The downside is that you're going to have to place more trades. And there's an argument over the risk because, as we saw, the success rate is nearly the same regardless of what time frame you go on for a given zone. However, since you do have to make more trades on the lower time frame, I contend that there's more risk because there's more chances for things to go wrong, if nothing else. In which case, what we see follows the old relationship between risk and reward. The more reward, the more risk. The more risk, the more reward. And we see the same relationship on NQ as well. If we look here on the 60-minute chart, again, we see using our wide method for drawing the zones. There's 26,500, roughly speaking, on the table each month on average. As we go down to the 15, that more than doubles. That goes up to 70,000. And down on the 5, you're up to 146,000. So that's the same thing we saw in oil, where as you go to the lower time frames, there's more money to be made. But you will have to do more trades in order to capture it. The other thing that's interesting here is that even though oil is $1,000 a point and NASDAQ is only $20 a point, you do get more price movement on NASDAQ. And so that shows that potentially you could be making more money on the NASDAQ. And that's consistent across the 3 time frames here. Let's go, at least in 2018, let's go see if this is consistent now. Let's go look at 2019. A little too far. Okay, cut down one more. Okay, so in 2019, again, we look at oil. Again, drawing the zones wide gave us the best results in terms of points in play. And we see again, going to the lower time frames, there's more points in play. There's more money to be made on the lower time frames. On the NASDAQ, again, we pretty much show the same thing. As we go down in time frame, the potential earnings go up. And interestingly, we still see again that you could have made more money on the NASDAQ than trading oil. If we go to 2020, again, pretty much same relationship. As we go down on interval, the amount of money to be made goes up. And that holds whether it's oil or the NASDAQ. And again, interestingly, we see again on the NASDAQ, you could have made more than trading oil. This is the power of back testing, where you can actually get the data and compare things like this to see if you're trading, the right markets. And let's go look at the higher time frames too. We go down here to the points in play. Now again, this is over a 5-year span. But interestingly here, over a 5-year span, on the 180-minute chart, you could have made more on oil than on the NASDAQ. That holds on the 240, holds on the 480, holds on the daily. Interesting. But again, when you compare the amounts to be made here, you see that as you go down to lower time frames, generally speaking, the amounts to be made increase, except for the 180. The 180 is the odd man out. So that gives you an idea of how the zones that are found perform, or more precisely, what they make possible. How much of that you can actually capture depends on your trading system and the trade-offs you're making within your trading system. Now, at this point here, if people are interested, we can go look a little deeper at some of the trade-offs that are typically being made within your trading systems. We can go and look at, again, some more examples of the supply and demand trading methodology, in that I can load up some backtest data, and we can go and see how some of the different phases of the process play out. So we can look at, for instance, if we use a simple strategy, we can look at some, filters, and we can look at using a simple exit technique. We'll use a fixed targeting technique and see how that compares. Is everybody interested in seeing that kind of stuff, or has everybody had enough for today? What would you guys like at this point? We're actually a little overtime right now, so what would you guys like to do? Well, if nobody's got anything to say, then we can just wrap this up. Okay. So it looks like everybody's had enough. So then we'll just go and we'll just wrap this up. So over the last two sessions, last week's and this week's session, we talked about what a market looks like to us, and what it looks like to your computer, which really controls what it looks like to us. We actually got into what is a candle, and we saw how that candles are actually a form of sampling, and they come with all the benefits and all the problems associated with sampling. We looked at why we use candles. In particular, we need them to reduce the amount of data that's coming in, because the data coming in from the markets, there's just too much of it for us to be able to handle as humans. So we need a way to reduce the amount of data coming to us, and we need a way to slow it down to a rate that we can handle. Candles actually serve that function. We looked at why we have to look at multiple time frames, and that gets tied back again to candles being a sampling mechanism. We looked at the relationship between the law of supply and demand and a candle, and we saw how there's a direct relationship between them. We looked at finding areas where supply or demand were out of balance, and we saw how we were using swings and base highs and base lows, to find those areas. And we talked about how we were going to attempt to measure how big an imbalance of supply or demand there is at a given location that we have found. And that brought us to what patterns to look for, because those patterns are the ones that would most likely indicate areas of significant imbalance. And then we looked at how to make that objective. And we went through a whole series of cases at that point, looking at variations on the candle patterns and what that might entail, and how to draw your zones from those patterns. And today we saw in the backtest data how drawing those zones actually can make a significant difference in the performance that you see from the zones. Today we got into trend. We talked a lot about trend, and we saw the relationship between trends on different intervals and actually the impulse and corrective moves within trends. We talked about curve, exactly what we want a curve to be, and we were trying to get out of curve. And then we got into a simple method to actually draw the curve. And of course, then we talked about the backtest data showing the performance of the bands that were found using this objective methodology. And the final thing for today is that the computer does what you tell it to, not what you want it to do. Something to keep in mind with your trading platform. Now, if anybody has any questions, please feel free to visit the Foundry, or you can send an email to admin@sndsoftware.com, and we'll try to get your questions answered as quickly as possible. And if you want a copy of the slide deck used today, please send an email to admin@sndsoftware.com and put "Making It Objective Part 2 Slide Deck" as the subject line. That makes it easy to separate those out and send out the slide decks faster. So, any final questions? Any final comments? Okay, well, I hope everybody enjoyed the presentation. I hope it's useful to you all. Thank you all for coming today. And hopefully I'll see you all in the Foundry in the future. So everybody stay safe, stay healthy, and keep it green.